picture a wheelbarrow that has three legs. There's the two legs in the wheel. So we have the buy right, which is one leg, finance right, which is the other leg, and the manage right, which is the wheel. It's in constant motion.
Welcome to the Rental Property Owner and Real Estate Investor Podcast, brought to you by the Rental Property Owner Association, providing benefits and services to real estate investors and rental property owners for over 48 years. With your host, Brian Hamrick from Hamrick Investment Group.
This episode is sponsored by Green Property Management, managing everything from single-family homes to apartment complexes in the West Michigan area. Find out more at greenpropertymgt.com. And RCB and Associates, helping real estate investors and small business owners navigate the complex world of health insurance and Medicare benefits at rcbassociatesllc.com. Hello and welcome to episode 138. My guest today is Gino Barbaro, who many of you know through the Jake and Gino Wheelbarrow Profits podcast, as well as their book together, Wheelbarrow Profits, How to Create Passive Income, Build Wealth, and Take Control of Your Destiny Through Multifamily Real Estate Investing. Together with his partner, Jake Stenziano, Gino owns a portfolio of over 900 units valued at $55 million. He's also a certified professional coach and a best-selling cookbook author. Gino, welcome to the show.
Brian, thanks for having me on.
With you and Jake, you're the one who's considered the pizza guy. Is that correct?
That is correct. And he is the drug rep, or the formerly drug rep.
The pizza guy and the drug rep. Well, tell me why you're the pizza guy and how you went from being the pizza guy to owning over 900 units.
I will give you a 30-second overview of my life. 47 years old, just turned 48, got married 20 years ago. So this is my 20-year anniversary. I've got 6 children. Started the restaurant business in 1994 out of college. Couldn't find a job. I just hated Wall Street. Worked there for about 20 years and just became disgruntled. Did not like the business. Once, everyone knows about the year 2008, or they want to call it the Great Recession. For me, it was the Great Shift. I just said to myself, I don't like what I'm doing anymore. Let me get into something different. Let me find something where I'm going to enjoy. And it led me to, believe it or not, life coaching. And life coaching, I needed to work on personal development. I needed to find out what I wanted to do, not what I didn't want to do. That was the most important thing for me. I always focused on, hey, I don't want to be here. I don't want to be there. Once I started focusing on what I wanted, things became a little bit more clear. And it led me to multifamily real estate. And, fortunately, I was at the right place at the right time. I met Jake. We partnered up and we started buying properties back in 2013.
Wow. So let's talk about life coaching for a moment here, because it sounds like you hired a life coach to kind of help you figure out what direction you should go into.
That's a great question, Brian. Yeah. What I did is back in 06, 07, I was desiring to do something else. So I ended up hiring a life coach to write a cookbook. I mean, I was working multiple hours and I had no idea how to do it, right? I never did anything. So I actually had a life coach, less business coach, help me out and do that. And I love the process. I love the space. I was able to connect with somebody one-on-one. And a couple of years later, I said to myself, I want to go to life coaching school. So I went to IPEC, the Institute for Professional Excellence in Coaching, and got certified as a life coach. Not because I wanted to become a life coach, although it's amazing because the skills that you learn, the personal development you receive, the empowering questions, the energy blocks, the levels of energy, all the things that come about by becoming a life coach, they really propelled me, really helped figure out what I needed to grow as a person and what I want to do with my life. So I started out by using one, and then I said, you know what, let me go and get that extra personal development. And for me, it was, I think, one of the best things I've done for my career.
Well, I'd like to know more about that and why, because, some of the people that I know who are very successful, whether it be in business or in real estate, have worked with life coaches in the past or business coaches and received coaching. Tell me why that's something that changed your life.
Well, for me, I just knew that I was disgruntled and I didn't have anybody really to talk to about it. You can talk to your wife or talk to your friends, but they all have their own personal agenda for you. So for me, life coaching, when I started life coaching, it unfortunately is not as valued as, say, a business coach or a consultant, because life coaching, when you look at it, it's basically somebody's asking you questions and pulling out the answers from within me, because we all know answers to our own questions. The problem is we're all coming from a place of fear, and the life coach is supposed to make you realize what you're doing, shift your level of energy, increase that level of energy that you have, and then allow you to think, about the positive stuff and think that what's trapped within inside of you. So it goes from like the who, what, how. You know who you are, what you want to do, and how you end up actually doing it, let's say. And for me, life coaching gave me that space. And, you look at every single, person on this planet who's really super successful. They've got multiple coaches. Look at a guy like Tiger Woods or Michael Jordan. They have business coaches, health coaches, financial coaches. I mean, you actually want to get help from certain people. And I love life coaching because for me, I mean, all the tools and the techniques that I learned from getting myself and making myself into a better person, I would not have happened for me.
And can you give us any specifics? Like what was some of the fears that you may have had that your life coach helped pull out and helped you get over?
Sure. One of the things that we learned was there was energy blocks. Everyone has energy blocks, and they're all basically internal. 95% of all the blocks that we have are internal. Anything that's an external block would be something like the economy. That's external. We can't really control it, but internally we can control it, and they're broken down into 4 subcategories. We call them the Gales. First one is the limiting belief. Everyone has limiting beliefs, circling around them. Basic limiting belief I can just share with you is Roger Bannister back in the 1950s when he ran the 4-minute mile. The limiting belief was nobody can run this 4-minute mile. And, limiting beliefs hold you back. If you think that you can't make money unless you have it or money doesn't grow on trees, that's your limiting belief. That will hold you back until it becomes shattered. What happened once Roger Bannister ran that 4-minute mile, all of a sudden 6 or 7 other people within the next couple of months broke that 4-minute barrier also. The next one is the interpretation. When we go through life, we make so many different interpretations about every situation. Let's say I send you an email, Brian, and all of a sudden you never respond back to me. It takes a day or two. I can interpret that as Brian may be blowing me off or Brian doesn't like me, when in reality, Brian may have never received that email. So how we interpret life can really hold us back. The next one is the assumption. As you go higher in the chain, the assumption, it gets much stronger. The things that happen in our lives, I can give you an example for myself. When I lost money on a deal in real estate, I assumed that real estate was risky. I could have made that assumption and carried that throughout my life and never gotten into multifamily. The assumption is a strong one because it's happened in our lives. You see a lot of people who get into a relationship and end up getting divorced, and then they say to themselves, well, I'm never going to get married again. It's just tough. That assumption can hold them back. And I think the last one, the gremlin, is the biggest one. And I think everybody can relate to the gremlin because it's that inner critic. It's that voice inside of us that's saying, you're not good enough, you're not smart enough. And for me, it was just being in the kitchen, having that chef coat on and saying, I'm not good enough to do multifamily. You know what? I'm not as smart as the lawyers and the attorneys and these real estate agents. And there's one of two things that could have happened. I could have heard that voice and I could have said, you know what? I'm going to listen to it. Or I could have said to myself, as I did, I'm really pissed. I want to do something with my life. I want to get better. I'm not going to listen to that voice. I'm going to use that voice in an anger mode and in a motivation where I'm moving away from pain, and just acknowledge the voice and make sure that it's real, have it out there, flesh it out there. And the funny thing at school, what they made us do is they made us have some type of object that personify your gremlin. So I actually used a cooking spoon and I used my chef coat. So just to show myself that there's the gremlin. Why is it holding me back? I'm just as smart. I'm just as good as anybody else. And to be able to work on those things, to be able to work on that inner voice was really powerful for me.
Did you start off then, I mean, in working with your coach, did you develop a plan that led to where you are now? Over 900 units, $55 million in assets, best-selling book or books in this case, and an extremely popular podcast.
Well, when I first started buying properties, my goal ultimately was just to do something that I really liked. I wanted to get back and start contributing and growing. I think I got stuck at my job at the restaurant. I was doing the same thing every day. It was getting boring. So my goal once I graduated from life coaching school was really to try to shift, to try to get out of the restaurant, to try to leave New York, and to try to become financially free. Those were my goals, and that was really huge. So my one thing, as like to refer to. My one thing was to become financially free, focus on whatever it took to become financially free. But I started off by saying, let me start supplementing my income a little bit at a time, see where that takes me. And then I had this passive income number that I said to myself, I need to hit this to become financially free. But you know what? Let me take it slow at a time, a little bit at a time. Let me do one deal. Let me do another deal. I said, think big, but start small. And that's what I ended up doing to get that confidence on how to do this stuff. And, that's basically what I did. It has a lot to do with goal setting. I mean, your goals have to be passionate enough. You have to be really focused on what you want. And that's what I learned on. And, by creating partnerships and by taking that one step at a time, I was able to achieve a bunch of stuff.
One of your big partnerships is with Jake.
Mm-hmm.
How did you guys meet, and did you like each other at first, or did it take a while for you to warm up to each other?
Ironically enough, he was really good friends with my brother. He was a drug rep, and he was a pharmaceutical rep who was getting lunches out of my restaurant. He was catering lunches and bringing them to doctors' offices. And this is back in 2010. He was disgruntled as well, W-2, going through layoffs and just barely making them. And he said to himself, he was living up in New York. I'm leaving here. I'm going down to Knoxville. I said, let's stay in touch. I said, I'm looking to invest in real estate. And he goes, listen, I'm looking to do something else also. So, he goes down. I love the area, Knoxville. I love the submarket. I love just, it's a growth. It's a place where people are moving to. And I said, when you get down there, settle down. So he goes down in 2011. We start looking at deals. It took us about 18 months to find our first deal. And, after 18 months, we bought a deal. And I liked him because, there's a couple things I think everyone should look for in a partner. I mean, obviously, you want to have the same ethics, the same morals. You want to have the same goals. And Jake and I, we did not want to fix and flip. We didn't want to get a second job by, owning houses and flipping them. We wanted to go into multifamily where at least we can manage the deal ourselves while still working full time. And that's what multifamily allowed us to do. We wanted to create generational wealth, and we both wanted to get out of the W-2. And those are part of the things that I look for in a partnership. And also the fact that, he's an amazing guy when it comes to working. He's got an amazing work ethic. He pushes me. We're actually starting to write a second book. I'm not ready to write a second book, but, he said, dude, we're doing it. So you know what? I've got to jump on board. The partners should hold you accountable. And it's that has enabled me to do a lot in my life, is by having, being surrounded by great people.
I'd like to take a moment to tell you about Green Property Management. Not only do they manage everything from single-family homes to apartment complexes in the West Michigan area, they also manage my entire portfolio. So I can tell you from personal experience that their unique flat-fee management style is worth a closer look. If you feel that your property isn't operating to its fullest potential, then Green Property Management can help you take a holistic approach that will save you money, eliminate your headaches, and increase your net income. And if you're a property manager interested in applying Green Property Management's model, give them a call at 1-866-95-GREEN or visit them on the web at greenpropertymgt.com. Now, did you guys hit the ground running, or did it take you a while to scale up to where you are now?
It took a while to even buy our first property. I mean, when he got down there, we were struggling, we're floundering, we're looking at deals. No one was taking us seriously. He ends up going to buy a house, and I said, Jake, you're killing me. And it took about another 6 months after he bought the house. We got re-engaged. It took about 18 months from when he moved down there for us to buy our first deal. And then after that, 3 months later, we bought our second deal. And I always tell people, once you get that first deal, it's all about the momentum you built. It's all about the credibility you built. And, within a year after we bought our first deal, we had almost 200 units, 190 something units. We had three deals done. And then within 5 years, we had hit almost 700 units. So, what was it easy? No, but what happened was once you start focusing and you start having that confidence, deals start coming to you. You're able to analyze them quicker. You're able to, in the multifamily space, it's great because once you start putting numbers on and getting that growth, you're able to start hiring people. So it's not just a landlording situation. You're able to actually scale up and build a business. And that's what we found.
And what were some of the challenges during that period when you were building your initial portfolio?
One of the big challenges was just the basic accounting. I mean, I remember the first two deals we had, I was doing the bookkeeping up in New York. He was sending it to me. I was using QuickBooks. We didn't have professional property management software. It was a struggle that way. I think the other struggle was, Jake was still a W-2 employee. He had never run a business before. He had never handled employees. So from the hiring of employees perspective, it's a tough one if you've never dealt with it. I was in the business, so I had always hired employees, fired employees. So, but for him doing day-to-day management of the property, it was difficult. And, implementing property management systems, doing applications, making sure your resident manager is on the right path, and, handling properties and doing turns on apartments in the very beginning was challenging, because when you're by yourself or you got to hire that out, it's hard in the beginning. And those are some of the big challenges that we face in the beginning.
And what corrections have you made to make that a lot better for yourselves?
Well, through the years, we've been able to podcast some really amazing guys like Cameron Harold, Brian Scudamore, T. Harbecker, Dean Graziosi. These are all guys that have built amazing businesses. We stumbled upon a book called, Traction by Gino Wickman. We're able to start, thinking of working, in the business. I mean, not just only in the business, but on the business as well, creating systems, creating that vivid vision for our company, and, start implementing those systems on how to hire, how to fire, how to write employees up. And that was really important, because when you're doing 10 or 15 units, you don't need to think that. But when you start building up and you've got almost 30 employees now, it's a really big process. And we were fortunate from March of 2016 until December of last year, almost 18 months, we went without buying a deal, which to me was almost, saving grace, because we were able to say to ourselves, okay, hold on, let's get property manager software. We actually took on that portfolio. We ended up hiring a couple more leasing agents. We ended up hiring a regional manager, and we were able to actually start scaling and implementing those systems. And then when the last 3 months, we've put on an additional almost 300 units, we were ready to take that on. So, I mean, those are some of the things you need to do. You really need to start implementing those systems for you to be able to grow your portfolio.
If you are thinking of leaving your W-2 job and becoming a full-time real estate investor, one of the greatest costs you must consider is healthcare for you and your family. When I made this transition 5 years ago, I found the whole healthcare insurance process to be confusing and frustrating. That's why I'm glad I met Chad Creasy at RCB & Associates. Chad is a professional health insurance agent who helps real estate investors and small business owners understand and choose their best healthcare options. And best of all, his services are covered by the insurance company and won't cost you a dime. If you're expecting a change in your healthcare insurance coverage for any reason, then you owe it to yourself to contact Chad Creasy at rcbassociatesllc.com. So you're able to take advantage of that drought period when you weren't closing any deals to actually just build your infrastructure to be ready for the next time you close.
Yeah, and Brian, the unfortunate thing for me was, you saw what happened with the market, where you're used to buying stuff at 8, 9 caps, and then you're looking at stuff that are 6 and 7 cap rates, and you're looking at something that you were paying $30,000 per unit, and all of a sudden the market resets and goes to $44,000 per unit. Let's say it's hard, and I learned you have to take what the market gives you. And we sat there for like good 16, 18 months floundering and not making any deals work. But I was diligent enough. We teach the framework, the buy right, the manage right, and the finance right. I was not going to overpay for property, because, on the buy right, once it's done, you can't take that away. And I see what's happening in the market now. Guys are overpaying for deals with the expectation of rental growth to continue, with the expectation of cap rates to stay compressed. And I don't know. It was hard for us to pass up on some of these deals, but I look back and I'm really thankful that we did, because we were able to actually hire more people. We were actually able to, corral our systems, and it was a good time for us to actually do that. So like you said, when we added the additional, almost 300 units, we're ready to take them on. So can you go back and just repeat what you said, the 3-part structure, the buy right, manage right? What was that you just said? Yeah. It's that's why we're called Wheelbarrow Profits. I know it might be a silly acronym or picture in your mind, but you picture a wheelbarrow. It has 3 legs. There's 2 legs in the wheel. So we have the buy right, which is 1 leg, the finance right, which is the other leg, and the manage right, which is the wheel. It's in constant motion. So if one of those 3 legs on your investment is faulty, or is not working properly, or is not executed properly, what happens is your wheelbarrow tips over. And Jake is outside cutting grass one day. He's like, wow. It just came to him, right? After we had done 200 units, we had noticed that we were buying from mom and pop owners, and we were noticing that, wow, if you get your buy right proper, it's done, it's fixed, it's over. If you can get your financing fixed, that's another part that it's fixed and it's done. The managed right is a constant day-to-day operation, and that's what multifamily comes down to. I mean, everyone wants to complicate things, but that's really what it comes down to, those three legs. If you can execute on those three legs, you're going to have a really profitable investment.
And what if one of those legs is off?
Well, like you said, let's take a look, for instance, on the buy right. If your buy right is wrong, I mean, I bought a property back in 2006. I sold it last year in June. Unfortunately, I never recouped from that property. I've lost a ton of money on that property. I can't take away the buy right once it's done. Once you execute the buy, you can't take it. So I always tell my students and everyone I know, I always tell them no deal is better than a bad deal. So you really need to focus on the buy right. And I've been told by a lot of my mentors, a lot of people in real estate, that you make money in the buy. So I firmly believe that even if the market's escalating, I'd rather not overpay for something because I always want to limit my downside potential, my downside risk. The finance right's the same thing. And listen, if you've got stuff that's got short term, higher interest rate stuff on there, there's a risk to that. If you've got stuff that's community financing and you're on recourse, there's a little risk in that. I mean, that's where we start out, but you just have to really nail your finance right. On our first deal, we had terrible terms. We had a 5-year term, we had a 20-year AM, and we had a high interest rate. And fortunately for us, it was our first deal. We bought it right. We were bought it into an escalating market, so we were able to refinance it out. We still have that with the community bank, but we got much better terms on it. And I think the managed right is pretty self-evident. Everyone thinks they're just going to buy these properties and let them go, when in reality, they need to be nurtured. Customer service is the number one thing, I think, in real estate, why people vacate their apartments. Not because of higher rents, not because of any of the nonsense. They want to be served, and customer service is key and vital, and you need to focus on that aspect of it.
Now, you went a long period of time without finding a deal. What broke through for you then recently that you were able to pick up more properties?
I think the way we started underwriting deals, I think we're constantly stuck in that 8-cap realm when there just was no more 8-cap deals in Knoxville. If you remember, I think it was last year in September, there was a Hurricane Irma in Florida. I moved to Florida in June of last year, and it's September, and I'm like, I'm vacating for a hurricane. Are you kidding me? So I get in the car with the 6 kids. We get in the car. We drive up to Jake's house for the week. And we just had that inspiration. I'm like, Jake, let's go back and look at this property we had looked back at. It was 110 units. It had actually a HOA component to it, which is pretty tough when you're trying to get non-recourse financing. So it had, as everyone says, a little hair on it. So we ended up looking at it. We ended up underwriting it again. It made sense. It wasn't what we typically buy, get out of your comfort zone. And we ended up buying, we ended up closing it on December. At that time, we got another little 67 unit deal, same kind of thing. A little bit out of our comfort zone. Wasn't really a C property. It was a nice B property. Cap rates were a little bit higher, around 7, which was still really good for that asset. But you know what? We had to come up a little bit more money down, but we got Freddie financing for it, and we just loved it. And the third deal we did in December was a foreclosure. It was a 64-unit foreclosure that we had been hunting for the last 8 months, and we're still in the midst of repositioning that property. So every single property has been unique. Every single property has been specific, but they've all had that one thing, which is that value-add component where there's something on that property where we're buying it for the actual cap rate, but we're hoping with the expectation of raising that net operating income and increasing value on that properity.
Yeah, so that upside potential more than made up for the lower cap rate that you were paying.
It does, yes. I mean, and even with 7 cap rates in our market on the B-type assets, those are really great returns, especially in this market. Whereas, let's say 4 or 5 years ago, they might have been A+. That's what I said. You just have to reset yourself to the market, buying it right, but with the ability to actually increase that cap rate, increase that NOI. If you can't do that, I just don't want to buy the property then. You
guys are also kind of focusing on, and somewhat of a new direction that you told me about before the show. It's multifamily or multifaceted multifamily. Can you explain that and talk about that a little bit, please?
Sure. I was at a mastermind last year with a bunch of guys, and one of the guys was talking about multiple streams of income. And I said, that sounds pretty cool. And he'd been talking about it. And the way he showed me, he's like, he puts his fist up and he starts shooting out of his fist, drawing these lines. And he's like, this is your fist. Your fist is a wheel, and these are all different spokes of revenue. So I'm like, I like that analogy. And I had just brought it to our real estate. And I was like, wow, let me make that analogy to what we're doing in real estate. The spoke of the wheel is actually your investment, whether you have 100 units, 1,000 units, or 1 unit, and you're looking to add multiple streams of income. Our first one we did was the property management company. So we continue to run our property management company. We do our day-to-day operations. There's one revenue spoke from there. The second one was Jake and Gino. We started an education company without even meaning to start one. And there's so many multiple benefits to it other than, trying to monetize on it. The ability to get on podcasts, the ability to talk to Ken McElroy on a podcast, or like I said, to Cameron Harold, and the ability to, grow your network and become credible. So when you reach out to a broker, you can show them your best-selling book, or you can show them your podcast. So the education was the second one. And, when I talk about all these multiple streams, I mean, they are directly feeding off the original investment. I'm not talking about owning a car wash or owning a restaurant that has no correlation to your original business. The third one is the syndication. We're going to start syndicating deals. So we created that syndication arm of the business. The fourth one we're looking to do right now is we're looking to open up a brokerage because we want to start sourcing our own deals. And that's an interesting one. That's going to take a little bit longer because you've got to get your license and you've got to get brokers working and all. But that one we can see in the next 2 years. So as you see from that one little, revenue, that one little asset, you can grow multiple streams. I mean, you can also start a service company, whether you want to take on a plumbing company or an HVAC company that services your entire portfolio and does, other business. You can start a trash valet company. You can start product sourcing as you get larger. Why don't you start sourcing products in China, such as flooring or appliances, and whatever you have extra, you can start selling off to other multifamily investors. So, I mean, the sky's the limit. And if you can take this model and apply it across the spectrum to any other businesses, in the U.S.
So how do you go about creating all those different spokes without creating just an exponential amount of work for yourself?
That's an excellent question. It comes back to partnerships. I mean, I run the day-to-day operations at Jake and Gino, and Jake runs the day-to-day property management. If there was only one of us and we wanted to have the whole pie and we were greedy, there would be no way that we'd be able to do this. It's just like you said, there's no way. I love the day-to-day operations of the education company. We hired on a community director in the last 4 months because we saw the direction. I just couldn't serve it by myself. The syndication arm, same thing. Jake, we both hired somebody to run that syndication piece because we've got a few hundred investors finally on our portfolio and our platform that we have to service. So it's about scaling up. It's about, I think, also knowing what you want to get out of it. So when we started the education, we had no idea the direction. We just wanted to start a podcast. We thought that'd be cool. We wanted to write a book. We thought that'd be cool. But what was the direction? We didn't have one. And what I've seen over the last 12 to 18 months is they're all real symbiotic, because when you're doing the education company, let's say you'd like to sell somebody some type of education. Well, you know what? They don't really want education, but I have $100,000 to invest. Oh, great. I have a syndication arm. And it's the same thing. They work in such conjunction, whether we have a vendor who's working with the education that can help with the syndication arm. They just all work in conjunction. And I think what you need to do is, once you start scaling up, once you have the idea, the vision, you really need to work with your partners and bring other people aboard and help you.
And regarding your syndication arm, I had assumed that you were syndicating already, that in order to get to 900 units, you must have been syndicating. How have you been getting the money to do your deals?
Well, I just forgot to mention, we do things backwards, I guess, because everyone assumes that you start multifamily by syndicating, but no, all the units we've been able to purchase with just myself, Jake, and another partner. We started out with a 25-unit property, and we actually call our strategy refi and roll. So we've been able to buy properties, add extreme amount of value to them. The majority of them through community financing, and then we'll go to the agency financing. We'll refinance the proceeds out. We are in the process of refinancing another property right now, so that'll bring our refinance proceeds to around $8 million on our portfolio. So we just keep rolling those proceeds into the deals and just keep scaling up and keep scaling up. And the reason why we created the framework is the buy right. And that's one of the main reasons. If you buy right, like we've done, you're able to add that value and able to rescale the property and refinance the property out and just continue to, continue to buy new properties.
Wow. So that's okay. That's a great way to do it. And you've been able to build your 900 unit portfolio so far with just repurposing your refinance profits?
It's been that way. I mean, we haven't syndicated a deal yet. We're in the process of putting in offers right now to buy our first syndication because, like I said, we've got so much demand from people following us and people wanting to invest with us. But it's come down to that. I mean, you buy right. I mean, our first couple of deals we had our own capital. Our first 3 deals we put capital into them. Our 4th deal, believe it or not, was a 281 unit property. It was an $11 million investment, but it was no money down. The owner held a 20% note on the property. So that one didn't come out with any capital. We actually, at the closing, came out of the closing with, I think, $100,000 at closing because prorated rent, security deposits. So, think creatively. You have to do things creatively. Was that going to be our first deal? No. But, I mean, that deal has been an amazing deal for us because we refinanced that property twice, paid the owner off, and now we're withdrawing additional capital from that property.
Wow. So you were able to get 80% financing from a lender, and then the other 20% you were able to borrow from the seller, huh? From the seller,
yeah. And you know why it worked? It was one of those deals that was in between. It was one of those that a mom and pop investor can't take down himself. And it was one of those that a REIT was just not really thrilled of. It was split up into 281 units. We split it into 2 different LLCs, 156 units that were contiguous. That was a nice part of the portfolio, and 136 units that were spread out in the city. It's a college city. And unfortunately, this is where, I guess the creative thinking comes into play. We saw it as that. If the seller had tried to do that and tried to sell the 2 assets separately, he would have had a much easier time to sell them and he would have sold them quicker, but he didn't do that. We saw that that's the way it should have been held. We actually went and got our financing that way. And I mean, it worked out great for us. The properties are really, they're really well. They're doing really well for us. And like I said, we've been able to, pay the seller off.
Yeah, it's fun in buying apartments or real estate where you can really get creative in the way you put your deal together. But it doesn't sound like money ever really stopped you from doing a deal. Was there any point when it was you and Jake and your third partner where you just didn't have the funds to do a deal you wanted to do?
I don't. That's a good question. Maybe between those 18 months we floundered. We weren't looking at big deals. See, the problem is we're still looking at deals right now. We're looking at 100 units. It's about $3 million, about $30,000 a door. We want to start syndicating because we want to start looking at the $20 to $25 million assets. And I think that would stop us from using our own money because you obviously run out of money. So it's part of now the growth phase, now getting out of our comfort zone. And that's why I think we need to start syndicating it and pushing our limits. We'll start with a small one. We'll start with maybe one that's $4 or $5 million. Make sure we do the proper raise. And I think that's what everyone should do when they first start out. Even though we've got the credibility and the experience, are we going to be able to raise $8 million in our first deal? I think everyone gets so anxious and so excited. But the reality is it's our first one. We've never done it before. We don't know the roadmap. I mean, we know it. I mean, I know it because I've been podcasting syndicators for the last 2 years. I understand the whole process. But when you do something for the first time, I would recommend to do it a little bit smaller, to do it in bite-sized chunks where, it'll be a lot easier for you. And if there are mistakes, they're not going to be huge mistakes. If we come up short by $100,000 on the raise, I'm sure we could find it somewhere. But I think that's what we've been doing our entire time, just taking it one step at a time. Once we figure something out, we move on to the bigger things. We try to grow from there.
So what has kept you from syndicating up to this point? Is it just
that's a great question.
Yeah, I mean, either you had the funds to just do your own deals and you didn't need to, or there was some limiting belief that prevented you from doing it.
Yes, Brian, I like the limiting beliefs. I like that, Brian. Couple things. I mean, the first thing was the limiting belief of I got to get investors. I'm beholden to investors. I might make a mistake with their money. I might have to do something on the property that if I've got a rate of return for them, but it's not a great strategy for the property. All those things kept coming up. And I think ultimately for me also, syndication, I sometimes look at it as a glorified fix and flip strategy where, 3 to 5 years down the road, you're out. You have to sell the property. You have to either cash out. Hopefully you can do a refi, but if not, you got to sell the property. And syndicators make money on the back end. They make it with fees, and they make it on the back end of selling it. And our strategy has always been to buy and hold. We like to cost segregate, get those tax benefits, get the cash flow. So I think that's been one of my limiting beliefs. But, the amazing ability with syndication where you can leverage other people's money and you can get into much bigger deals. And for us, it's pretty much a no-brainer because if we can go from 1,000 units to 2,000 units in the next year and a half, we could really scale our property management operations, our education will load, and, the fees from the syndication will allow us to, generate new employees.
There's also a flip side to the fear of bringing on investors that you're somewhat beholden to. And that is, if you're just doing deals with your own money, maybe you're not as concerned with your returns and the performance of that asset.
You're right. No, you're right. And I have a partner that holds us accountable. You can become a little sloppy with your money. You can say to yourself, you know what, I can hold off a little bit. I don't need to get that 8 or 10% cash on cash. That has not happened to us because we're really diligent about that. There's no money left in the account at the end of the month. It gets drawn out. We don't want to be fat. We don't want to be wasteful. And when you do manage your own assets, you're looking at the balance sheet and income statement every day. You're able to control costs, and being that catchphrase that being vertically integrated really helps us with our operations.
Well, I'm curious about the idea of holding your partner accountable because I've always believed that partnering is a great way to kind of leapfrog your whatever it is you're doing. Get further faster through partnerships. But at the same time, there's an obligation between partners to hold each other accountable. Can you talk about some of the ways that you and Jake have maybe butted heads and had to point out, some unpleasant details to each other?
Well, that's another great question. I mean, a week ago, he's pushing me to write this book, and I'm not ready to write the book yet. I've got, like I said, we just hired the employees on. We're just putting another 2 deals in the contract. We are refinancing a property. The education's going great. We've got on-site intensives. I've got a live event coming up in October, and he's like, we got to write this book. And I got the cost of the book, and I'm like, wow, ghostwriting is not cheap. And he's like, dude, suck it up, MIH. So I'm like, okay, I guess I got to do it, right? If it wasn't for him, I probably would have said to myself, make all those excuses like everyone else. It's a little fearful, but you know what? I said to him, give me a couple months. I want to work through this multifaceted and multifamily. That's what we're going to be writing about. So we're going to be doing a couple of presentations over the next couple of months at a couple of, live events that we're going to also. Let's work on it. So, I mean, I wouldn't say butting heads, but I mean, definitely he was really gung-ho about the whole process and writing the book. And I'm like, okay, I can do that. But if I didn't have a partner, the book would not be getting written. I would have been just like put it on the back shelf. I would have made an excuse for 6 months, and then 6 months from now, I would revisit it with less energy, coming up with limiting beliefs and saying, you know what, I don't have the time. So I think partnerships are great. I think if anybody can jump on and create mastermind groups, I think masterminds are just as good. Even once a month you get on a phone call with a bunch of guys that you're in the same business, you've got the same level of energy, and every couple of weeks you hold each other accountable. What are you doing? How many brokers you're calling? How many deals you're looking at? That works really well. That cannot be underestimated, as far as using those tools to achieve success.
Can you talk about some of the groups you're involved in then and the way that, you're holding each other accountable?
Sure. I mean, first thing was that life coaching school that I went to. It was great because what we would do is we would, call up every week. We'd have coaching calls with all the other students. When I graduated from there, I missed it a little bit. So I ended up creating mastermind groups with the Jake and Gino community. I also joined a mastermind group called GoBundance, bunch of guys. Like I think there are about 200 guys in the community, all multimillionaires, all business guys. They really push you. They're really some super successful guys in the group, and you just want to learn from them. I mean, the thing with mastermind groups is everyone's got resources. Everyone has certain skill sets. You're able to network with these people. You're able to ask them questions. If you've never done something and you're able to jump on a call with somebody who's done it before, I mean, that is really priceless. So as far as what we're trying to do with Jake and Gino, we've got my son who's 15 years old. So once a month, we're going to start doing a book club for the community. Get everybody on. Whoever wants to get on, we'll discuss a book, stuff like that. Just start small start getting people together. I mean, we're going to start creating meetups also with Jake and Gino. Anywhere you can get together with other people who are like-minded, who want to do what you do, who are just positive, full of energy, and they can hold you accountable. That's where you need to be.
And talk about your podcast too, because you've interviewed a lot of really respected and successful business owners and real estate investors. What are some of the common themes that you have discovered through hosting the podcast from your guests?
Let me think about that for a second. It's such a great question. I mean, I think the funny thing is most of the guys who are super successful, they're just regular people. I mean, I used to put everybody up on a pedestal because I would say, wow, T. Harbeck or wow, Dean Graziosi. And I think they're just regular guys like you and me. I think they've figured out the key to success. They have some really good habits. They stick to their habits. I think the other thing is the majority of them, the vast majority of them are hard workers. They work hard, but they work smart too. And I think they know what they want. I think that's what I've noticed. And I think a lot of them, I don't want to call it risk takers, but I think they've overcome their fear and they just say to themselves, hey, listen, we only live once. Let's take the chance. And I think that's what it is. And I think a lot of them also, I don't think a lot of them work for money. I think a lot of them work for success and to achievement, and the money comes as a result. I think that's what I've seen through a lot of people who've been super successful.
So what's the big picture now? Now that you're expanding, you're going to be syndicating, raising millions of dollars through syndication. Where do you hope to be in the next year and 5 years, 10 years?
I hope to be on the beach in Florida still. That's my ultimate goal. I hope to be down here homeschooling the kids and just enjoying life every day. I think that's my main goal is. I mean, when I became financially free, I always tell people it's, you work who you want to, when you want to, where you want to, and why. And that who is really important. I want to work with people and network with people who are great people. That's what I want to work with. And I just want to continue to work. I love doing what I'm doing. I'm never going to retire. I just want to continue to help people with whatever, whether it's getting on a call, being nice to people, whether it's sharing kind word with them or helping them out on their business. That's what I see myself doing. And as far as scaling up, and I have no idea as far as that. I haven't even looked that far out. I should, because I should preach what I practice or practice what I preach. And I always tell people look far out, but these last 18 months have been a whirlwind for me. I moved from New York about a year ago, and I'm still getting my bearings down here, trying to I guess continue growing.
Being that you're a coach yourself, what do you think some of our listeners are going through trying to get into real estate and some of the problems they're encountering, and what would you say to them?
Well, I think the first thing is focus on what you want to get into. I think the next thing is focus on the specific niche you're trying to get into. If it's fixing and flipping, go out and find a mentor or go out and find somebody who's done it. Go out and get out of your comfort zone, because real estate is not like school where you do things by yourself. Real estate is a team sport. I learned that real quick. You need a good broker, you need a good property manager, you need a good inspector, you need a great team around you to succeed. And it's the same thing in multifamily. Go out and find somebody who's doing multifamily, learn them. Don't be afraid to make an investment and spend money on your education, because that's what really propelled me. Once I started spending money on my education and I had quote unquote skin in the game, I took it seriously. Free advice is great, free information is great, but most people don't act on free because they don't value it. That's the first thing I would do. I think the second thing I would do is, work on your personal development. Start listening to those positive messages. Start reading the Napoleon Hills of the world. Start listening to Gary Vee and start getting motivated. Start becoming inspired and focus on what you do want. I mean, most people, when you ask them what they want, they'll tell you, well, I don't want that. Really focus on what you want and what you're trying to achieve in your life. And I think that will ultimately lead to what you want to do. And then, like I said, just continue to educate yourself and continue to surround yourself with those positive people. Great advice. And if someone wanted to get a hold of you or find out more about your book, your podcast, your syndication, how would they do so? Real simple. Website is jakeandgino.com. Go on there. I've written over 150 articles. I think Jake said we've been on the podcast for 3 years. So our podcast, Wheelbarrow Profits, you can find us on there. We are having a live event this year in October, the 6th and 7th in Nashville. So if you want to, buy tickets, go online. They're really cheap, $20 to $50 a ticket. It's going to be an amazing event. We had a great event last year in Knoxville. So I said, let's do something where people can get to easily, enjoy the weekend, have a great time in the city. So we decided to do Nashville this year. So, hope people can check that out. Love to see him down there. And you know what? My email is gino@jakeandgino.com. If anybody has any questions or just wants to shoot a comment, I always love to talk to people. So please hit me up.
Well, Gino, I want to thank you for taking the time to share your experiences and stories with us. I mean, it's really a pleasure talking with you, and you've got a real inspirational outlook on real estate investing and life itself. So thanks a lot, and it's been a great chatting with you.
Brian, thank you.
This episode was sponsored by Green Property Management, managing everything from single-family homes to apartment complexes in the West Michigan area. Find out more at greenpropertymgt.com. And RCB & Associates, helping real estate investors and small business owners navigate the complex world of health insurance and Medicare benefits at rcbassociatesllc.com.
You've been listening to the Rental Property Owner and Real Estate Investor Podcast, brought to you by the Rental Property Owner Association. You can find out more at rpoaonline.org. If you enjoyed this podcast, please go to iTunes to subscribe, rate, and review.